Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, welcome. We have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. It's all happening this week. It's been a big week of economic news.
Yeah.
So we'll unpack it all in this episode.
But that's not all we're doing, Ren. Cheat Sheet segment is back. We go under the hood of Caledonia's latest investments, and then we're closing out with a community question on how to approach selling down a large portion of a portfolio and redistributing that into other investments.
News and markets.
Headlines we're covering today. The RBA has shocked Australia. Trade war is back on the agenda. London is falling, and so are Australian property investors.
Nice. All right, well, let's start with the big economic news of the week. Here in Australia, it was all but guaranteed, Bryce. It was as certain as a sure thing is certain, if I've used that phrase correctly. The Reserve Bank of Australia was going to cut interest rates.
Yeah.
And then they said, no. We still have a few surprises left. The Reserve Bank held rates at 3.85%. Before we get into what happened, I just want to give some colour on just how certain economists were. So markets were implying a greater than 90% chance of a 25 basis point rate cut. All four of Australia's big banks had come out and said there was going to be a 25 basis point rate cut.
Yeah.
The AFR surveyed 36 economists. 32 said there was going to be a 25 basis point rate cut. And speaking in the office after the announcement, some mortgage brokers had already emailed their clients and said 100% guaranteed rate cut.
Yeah.
Now, we won't name and shame, but that is important context for what happened on Tuesday.
Serial offenders, mortgage brokers, they love to crow it early. Anyway.
It's funny because, it doesn't make me more confident that they're going to do a good business.
Yeah. I know.
Separate conversation.
Anyway, so the news, you're right. The board voted 6-3 to hold rates. They've said with the cash rate 50 basis points lower than 5 months ago and wider economic conditions evolving broadly as expected, the board has judged that it could wait for a little more information to confirm that inflation remains on track to reach 2.5% on a sustainable basis. So it's a watch and see from Michelle Bullock.
So I think the important thing to stress is that Australia's headline inflation is 2.1%. That's CPI, Consumer Price Index. But the trimmed mean inflation, which is the Reserve Bank's preferred measure of inflation, takes out some of the temporary measures. We're at 2.4%, I believe, in the most recent read. So right in the midpoint of the 2 to 3% target.
Yep.
There's obviously some questions around the global economy.
Yeah.
But I think it is fair enough to take a wait and see approach, given that no one knows what Trump is going to do, let alone Trump himself, probably.
Yeah. I'm just reading through the announcement, and it's funny because at the last board meeting, the RBA apparently even considered a jumbo 0.5% point move this time around. So 50 basis points this time around. So a lot has changed from their point of view in less than a month.
You know what hasn't changed?
The impact that it has on us.
So I thought you were going to say the cash rate. But no, you know what hasn't changed and may never change, although we're going to certainly try and make it change. Every piece of financial and economic news in Australia is refracted through the property market.
Yes.
And this was no different. The first article that went up, news.com.au, shock blow for Aussie mortgage holders.
Of course. Still a lot of unknowns with the global impact of the tariffs as well. So we'll keep an eye on it. But the trade war is back on the agenda.
Well, you mentioned the uncertainty around the trade war. Well, we had our 90-day reprieve. I hope we enjoyed it because trade war is back, baby.
It is. So, yes, Trump 90-day pause. So new tariffs are going to be imposed on countries from the 1st of August that haven't signed trade deals with the US to this point.
Yeah, well, given that only 2 countries have signed trade deals and both of them probably won't complete, the UK and Vietnam, seems like a lot of countries are about to get tariffed again.
Yeah.
Their initial tranche was 14 countries got letters. Interestingly, tariffs moved a little bit. Some were raised slightly, some were lowered slightly. I guess the key headline was nothing below 25%.
Yeah. So Japan got 25, South Korea 25, South Africa 39. We don't have a full picture just yet of how it's going to transpire across all of the countries. But again, one to watch and really actually wait and see is the sort of the mood at the moment.
Yeah, markets fell 0.8% when the first 14 got announced. You would expect that there will be some volatility as we once again enter that post-Liberation Day mindset of like, what will this mean? But I don't think there's a lot of value in us speculating or anyone speculating about what it will mean. I think it's just continue watching and don't lose your head when sensationalized media headlines want you to.
That's it. All right. Well, we did say London is falling, but to be more specific, it's the London IPO market that is falling, hitting a 30-year low.
Yeah. So in the first half of 2025, British companies listing in London raised £160 million. That's at least a 30-year low because records only go back to 1995. So it's the lowest recorded. The previous low was after the global financial crisis, the first half of 2009, £222 million raised. So a meaningful percentage lower than the post-GFC world. And it's a real sign that the London market there's a sense of malaise, I think, there. Like, exciting, dynamic companies aren't listing in London anymore. They're choosing to list in America, mainly. Shein was one that was going to list in London, the Chinese fast fashion giant, but then they got blocked from listing in London, and I think they're now either going Hong Kong or mainland China, probably Hong Kong.
Yeah.
But yeah, it's pretty grim for London.
Well, I mean, the story continues, I think, globally, but here in Australia. So those numbers you've done there, Ren, are on value raised.
Yep.
But if we look at just total quantity of listings here in Australia, 2024 was the lowest in the last 20 years with just 29 listings. And that came after the previous low, which was 2023, the year before, of only 32 listings. So as more companies stay private longer and longer and longer and can raise capital outside of going public, it's not surprising.
Yeah, I think it's a real policy problem that at some point policymakers are going to have to get serious about. Like, the share market has been this great democratizer of finance. Private equity, private markets, larger VC funds that can do later and later rounds have been a force for the undemocratization of finance, because all of a sudden, to have access to those companies, you have to have a certain amount of money, you have to be in the right vehicle at the right time, and then you also don't have liquidity on the other end often for a long time. And obviously there are good arguments from companies themselves about why being listed is annoying and why being private is a better way to run the business. There's certainly arguments from private equity companies, from private equity managers, that alignment that you get in a private equity structure delivers better outcomes, better returns. But, that means they're hiring more people, they're satisfying more customers' wants and needs and all the rest. And that perhaps public company boards are more focused on
incentives,
different priorities other than growing the company to the maximum extent possible. That it can all be true, but we have a serious problem as less and less companies are listed.
Yeah.
So I think there should be a renewed push in government to get more companies to list. And whether it is different policy treatment, whether it is different tax benefits, we should want more listed companies that every man, woman, and child can invest in.
Yeah, absolutely.
That democratize access to these incredible builders of wealth.
Well, if you're in government and you're listening, we would love to chat. But Ren, let's close out with a what the, and London isn't the only thing falling. The Australian property investors here in Australia are falling for only the third time in 25 years.
Yeah, now this number's a little old, but the ATO just released it. So in the tax year of 2023, as you said, the third time in the past 25 years, the number of property investors fell. Now, it was only a marginal fall, 0.3%, or 7,081 fewer Australian property investors. And what we mean here is investors that own property that they're renting out.
Yeah.
Because in some arguments, the way Australian culture is, every Australian that owns a house is a property investor, owner occupied or not.
True.
Everyone is banking on that asset growing.
Yeah. No one's. Yeah.
We all have an investor mindset when it comes to property.
Very true. Very true.
But yeah, in terms of property investors of rentals,
Yeah.
it fell for the third time in the past 25 years.
Yeah.
Is that a sign that Australians are waking up to alternative ways to grow their wealth?
It's not, Ren, unfortunately. Unfortunately, driven by two things. Firstly, less investor-friendly tax and policy settings, particularly down in Victoria of late. But you noted this is from 2023. And of course, the interest rate rises around that period in 2022 and 2023 obviously had an impact. So when the new data comes out from now, it will be interesting to see if they're back on the agenda.
I'm sure they will be.
Sure they will be. All right. Well, if you want to keep up with more than just the headlines in today's episode, make sure you're subscribed to our daily newsletter where we send you a summary of all the headlines making news around the world straight to your inbox, 6 a.m. every morning. You can find a link in the show notes or in the description below to sign up.
A cheat sheet is a quick reference guide or concise summary of important information.
One of Australia's most notable fund managers has just made 2 investments. So in today's cheat sheet, we're going to unpack both of them.
Yeah, now the fund we're talking about today is Caledonia. For people unfamiliar, how would you describe them? They're like a highly concentrated, often contrarian... private fund manager that really just invests for like
them
incredibly wealthy people.
Yeah, they're owners.
Is that a fair? Well, yeah, but I guess what I was trying to say is that like you and I don't really have a sniff of becoming unit holders in their funds.
No chance.
And I think like when we say very concentrated, we mean very concentrated. Back in 2018, 85% of their portfolio was just invested in 3 stocks.
Yeah.
Those 3 stocks were Zillow,
yes,
the property portal over in the US, Grubhub, and Stars Group. And it's also notable that they are slow to act in some ways. Like they're very low turnover. They'll stick with positions for a long time. They will be slow to add new positions. Their last major long position was in September 2020, which was a Light and Wonder.
The gambling related company?
Yeah.
It was your stock of the year at one point.
Yeah.
A couple of years ago?
Gaming machines.
Gaming,
Yeah. So the 2 new investments were first reported by Joe Aston in his new newsletter, Rampart. They were both initiated in May.
Wow.
So 2 positions back to back. So we wanted to have a look at these 2 stocks today, understand what they were, what they do, and why they may have been new investments. The 2 are Royalty Pharma and Cameco Corp of Canada. So which one do you want to start with, Bryce?
Let's start with Royalty Pharma. We should say both of these companies are listed overseas on the US market. So Royalty Pharma, listed on the NASDAQ, ticker is RPRX. This company is pretty simple. They acquire royalty interests in pharmaceutical products.
Okay, you say it's pretty simple, but people may not know what you mean there. So explain what a royalty interest is.
So they effectively buy into a product or a part of a pharmaceutical company and then get the royalty payments from the sale of that product. They get an annuity stream.
You can't use the word in a definition.
They get a portion of payments from the sale of the product.
Now, Australian investors are somewhat familiar with the royalty structure because there are some mining companies that also have similar royalty streams. For Royalty Pharma here in particular, a key part of their business model is they provide capital to innovators or pharmaceutical companies in exchange for a share of future sales.
Yeah. So I guess to be specific, there are a couple of deal structures that they do rent. So they have acquisition of existing royalties from universities or small biotech companies. They co-develop financing, so they pay a partner upfront for the rights of future sales, as you said, or they have debt deals where pharma companies take debt and then they get access to future cash.
Okay.
Yeah.
There you go. And so the specific royalties that Royalty Pharma have here are reportedly focused on blockbuster drugs.
Yeah.
There are 45 royalty streams they have now across various therapeutic areas: cystic fibrosis, oncology, neurology. They're one of the biggest players in the world, and they were responsible for the largest royalty transaction in the pharmaceutical industry, or at least one of the largest. In 2014, they acquired the royalty rights from the Cystic Fibrosis Foundation for $3.3 billion.
Huge.
So they're a big player in this space.
Yeah. You said they have 45 there. The top 5 products or royalty streams make up about 64% of their total royalty receipts. Pretty interesting business in terms of financials: revenue of $2.3 billion, net income of $1 billion, and some pretty incredible, or consistent, I should say, revenue growth over the last few years.
We should be clear though, their revenue actually dropped between 2023 and 2024. So, like, there is obviously some volatility based on, like, the underlying drugs sales. To make a buy, hold, or sell decision on this stock, you would have to understand, 1, what royalty streams they hold, 2, the sales prospects of those royalty streams and the potential competition coming down the pike, and then 3, obviously a lot of Royalty Pharma has been built through acquisitions, so you'd want to have an understanding of the acquisition pipeline for new royalty streams. All that being said is I don't think we're in a position to make a judgment call on this company, but an interesting one nonetheless.
Yeah, absolutely.
Let's move on to the second company that Caledonia has initiated a position in recently.
So that's Cameco Corporation, listed on the New York Stock Exchange. The ticker is CCJ, and it is one of the world's largest uranium producers.
I think it's the largest non-government uranium producer after the Kazakhstani company.
They have some of the world's largest and highest grade uranium deposits around the world, but they're also expanding. They've just acquired a 49% stake in Westinghouse Electric Company, which is a global leader in nuclear tech.
Yeah, I mean, just 2023.
2023 is true.
2 years ago.
2 years ago.
Yeah.
Caledonia are playing the increased demand in energy and nuclear with what's been going on, particularly in the AI space at the moment.
I mean,
I would imagine.
Oh, no, definitely. Yeah. This one we can definitely talk about. Like, Royalty Pharma was probably a bit out of our circle of competence. But I think it is the trend is so abundantly clear that it's infuriating in some ways that Australia isn't playing a larger role. But we've seen all the big hyperscaler tech companies invest in nuclear. We've seen Microsoft literally restart one of America's largest nuclear power plants that was shuttered about 7 years ago, the 3 Mile Island nuclear power plant, and agreed to offtake all of that energy production for the next 20 or 30 years or something. We've seen Alphabet invest in modular and smaller reactors, same with Amazon. We've seen Meta get into the nuclear power game. We've seen Oracle get into this space as well. So there's a heap of money flowing there. But we've also seen governments get into it as well. In the UK government's most recent budget, they put a bunch of money on the table for nuclear.
China are building 10 nuclear power plants a year and have been doing for the last 4 years.
Actually? 10 a year?
Yeah.
That's
10
nuts.
a year. And there's I listened to a podcast recently about the total energy output of America, which is obviously, energy is obviously a national, not security.
Definitely
national
security.
security.
Yeah.
And China are now just absolutely smoking America in their nuclear and renewable energy output. 10 a year they are building.
Yeah, well, I mean, China's renewable build as well is just nuts. The rate at which they're building renewable power is unprecedented. Yeah. Anyway, that's a separate conversation. But the nuclear story, there's been so much investment in nuclear that obviously there are a number of different ways to play it. You can invest in the beneficiaries of this power, like the data centers and stuff. You can invest in the nuclear power generators. You can invest in some of the picks and shovels plays that service the nuclear industry. But Caledonia have decided they're going to play the commodity. They're going to play uranium, which like, you know, so there are three main uranium miners in Australia that we talk about, DPLO, Boss Energy and Paladin. And they've all had a really good run.
You say that, Ren, but I'm pretty sure Paladin is down 40% or thereabouts last 12 months.
Yeah, fair point. Look, they've been incredibly volatile and incredibly cyclical, but Paladin is up, more than 500% in the past 5 years. DPLO is up even more than that, I think like 600 and something percent in the past 5 years. So you're right. If you're going to play the commodity game, you've got to play the game at the right time, or you've just got to be with the highest quality, lowest cost producer who will be able to win through the cycle. Anyway, uranium, it is certainly getting a lot of talk. There's a lot of money moving into this space. So this one wasn't surprising, but yeah.
The energy trade.
It just always makes me think, will Australia ever lift its ban? I'm not saying the government not saying the government should be putting government money towards it, but will we just allow the private sector to do it for us?
Yeah, and there's a number of ETFs available for uranium, so if you're interested, check them out. Anyway, we're going to take a quick break, and when we're back, we'll be answering a community question on how you can sell down a large portion of your portfolio and reinvest it. We'll be right back. Welcome back to Equity Mates. We love getting questions from you. Today's has come in anonymously, but if you would like to ask a question just like today's listener has, please head to equitymates.com/contact and leave us a speak pipe.
Hey guys, currently I've got a large majority of my portfolio in a single Aussie mining stock, and I want to look to rebalance that to get into a diverse growth core. Talking a lot about dollar cost averaging on buying in. I keen to hear your thoughts on this with selling down and restructuring when it's a large weighting of a portfolio. I've been sort of tossing around DCAing the sale and then buying into ETFs and selling good chunks to capture more time in the market alternatively. Perhaps a hybrid of the both, various large volumes and DCAing some remainder. ChatGPT thought 50 to 60 sell and then DCA the rest. Anyway, keen to hear your thoughts. Cheers.
Well, thank you for the question, and a reminder that if you do want to ask your question, you can ask it anonymously like this person. But Bryce, knowing when to sell, it's one of the harder parts of investing.
We should firstly start by acknowledging that this listener has recognised that there's a bit of concentration risk going on in the portfolio, and that probably diversifying is a good thing. I think having a large amount or just a one stock portfolio for the long term can leave you very exposed to the fluctuations for that one particular stock. So knowing that you want to start diversifying, I think is a good place to start.
Okay, interesting. So you read this question or listened to this question as if they had just put all their money in one mining stock. I listened to it as if they had had a massive win.
Okay.
They'd bought a stock and it had 10 bagged and now it was a big portion of their portfolio. So I choose to live in that world where the listener has just had a big win and wants to know what to do with it.
Yeah, I mean, congratulations.
So I think probably for us there's 3 steps. They're general, but unfortunately there are some nuances and some specifics around like what the company is. Do you still believe in the company?
Yes, yeah.
How much risk is inherent in like the company's valuation at this moment?
Yeah.
What are your financial goals and your risk tolerance? And like these are all things that we don't know. So it will need to be general, but I think hopefully it will help you think about how you approach the question of when to sell and how much to sell.
Yeah, let's assume this listener is ready to rock and roll and sell, which it sounds like they are.
Yeah, but I mean, like, for example, we can bring this forward. For example, it's not just are you ready to sell, but it's like, are you optimized for tax?
Yes.
If you haven't waited the 12 months to get the capital gains discount, I would suggest, especially if you've 10 bags of stock, it's probably worth waiting.
For sure.
Yeah. So it's not just about do you feel ready, it's about like have you optimized the timing.
Yeah.
Also like what's your tax position in this tax year? Is this the right time to sell or is it best to wait for another year?
Yeah.
Anyway, all of that stuff.
Yeah.
It's mainly about tax.
It is always tax.
So tax consideration, we've talked about tick. All right. So I reckon there's probably a 3-step process that we go through. And the first one is actually start at the end. So start at the end goal in terms of what you want your portfolio to look like once you've done the rebalancing.
Yeah. I think that's anything from, do I want my portfolio to be one of the all-in-one ETFs? Do I want it to be a mix of core index ETFs that you're managing the weighting? Or is it going to be a portfolio of a bunch of individual stocks?
Yeah.
I think all things that you need to be pretty clear on before selling and just starting to throw the cash into the market for the sake of it.
And specifically here, it's knowing what weighting you want an individual stock to be in that end portfolio, because that should dictate how much you sell. Like if you say, I want each individual stock holding to be no more than 10% of my portfolio, then you should be like, all right, well, I'm going to sell the amount that gets me to that weighting. No half steps, just like
do what needs to be done.
Do what needs to be done.
Yeah.
And if you think that's selling too much and you're taking too much potential reward off the table, then you probably either need to reconsider the rules that you've set for yourself because you're not comfortable with them, or you need to reconsider, I guess,
why you're selling,
your risk tolerance or something, and maybe you need to say, oh, I'm actually willing to take more risk because I don't feel comfortable selling this much. But like have a plan, have some rules, and then sell to what gets you within those rules.
Yeah.
So that's step 1 and step 2.
Well, the only step remaining is step 3, and that's to reinvest it immediately into the portfolio.
So interesting you say reinvest it immediately, because the questioner was talking about wanting to dollar cost average in. So why are you saying reinvest immediately rather than DCA?
I think for me, like, let's just take a situation. Let's say it's 50 grand we're talking about. You've already got 50 grand in the market working for you. I think to take that out and then DCA that into probably a more diversified, I'm assuming, portfolio, like you're already...
Well, it will be more diversified because it would be impossible for it to be less diversified.
Exactly. So you're already kind of reducing the risk. And so then having money not invested in the market and sitting there DCAing, you're kind of just losing time in the market. It's like you've been comfortable with the fact you had 50 grand in, so you may as well just get that 50 grand in as fast as possible.
Yeah.
That's my view. There might be other ways that you could do it, and what DCAing, I mean, is an alternative. I think the stats also show though, Ren, and we've done this on the show at some point, that if you do have a lump sum, it's actually better just to get it in.
Yeah.
So don't sort of... I think as long as you know what you're going to buy, what weightings you need, I'd just be deploying that straight away.
Yeah. DCAing is super powerful, don't get us wrong. But the most powerful way to do it is put your money to work as soon as possible and then continue to DCA with money you're getting
cash
from
flow.
Your income sources. Yeah, your job, or like, dividends paid on investments, or whatever it is, like wherever you're getting cash flow, putting that money back to work. Yeah, unless you have like a low risk tolerance and you're not comfortable putting all that money to work at one time. But we're assuming, given you have so much money tied up in an individual stock, you have the risk tolerance to put that money to work in the market.
Yeah.
So just put it to work.
Just get it in there.
Yeah. So 3 steps. Start with the end goal. What do you want your portfolio to look like? Sell down your positions so that the big meaty positions then fit those rules, and then take the cash that you freed up, and reinvest it to reflect what you want the portfolio to look like.
Yeah.
The right weighting between core and satellite. In your satellite, the right weightings for individual stock, like if it's 5% per stock, 10% per stock, whatever you want. And then in that core, making sure you've got, good, low cost, globally diversified index tracking ETFs is how we would go. But whatever it is, just like a really solid idea on what you want your core to be.
Yeah.
And then just keep dollar cost averaging in.
And then try and find the next 10 bagger.
Yeah.
It's easy as that. Love it. Well, thank you so much for the question. There'll be a link in the show notes or description below if you would like to ask one yourself. But Ren, that brings us to the end of today's episode. Always great to chat stocks. If you could leave us a rating and a review on your podcast app, or like the video and leave us a comment below if you're watching us on YouTube, that would be really appreciated. But Ren, as I said, always good to chat, and we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.